Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing VICI property stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. VICI Properties is a REIT that specializes in casinos. It was formed as part of the Chapter 11 bankruptcy reorg of Caesars Entertainment. After filing bankruptcy in 2015, Caesars proposed splitting into two companies, a REIT, which would own the company's casinos, and an operating company, which means the operating arm would manage the casinos. The plan was designed to maximize value for Caesars creditors by taking advantage of favorable tax treatment for REITs. The spin-off of VICI was completed in October 2017, the day that Caesars emerged from bankruptcy. The REIT has 43 properties in 15 states, 3.8 million square feet of casino space, and 58,000 hotel rooms. The company is headquartered in New York City and was founded in 2017. The ticker trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a large cap company, 22 billion market cap. They're trading at $29 a share and they have 748 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is growing from 500 million up to 870 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that almost doubled from 530 million to a little over 1 billion. Revenue is the sales for the company. That's the rent and lease payments they collect from their properties. And that's increased from 900 million to 1.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. They don't have much in cost of revenue, only 49 million. Revenue minus cost of revenue gives you your gross profit, and that was highest in 2021 at 1.5 billion. Below that is their operating expenses, which was lowest in 2021 at only 17 million. In 2020, they had high operating expenses. That's mainly due to posting provisional losses. When you post provisions, it's like putting money on the side for future potential losses. So the cash did not leave the company, it's just sitting in an account in case they have losses. I'll show you on their operating cash flows where we add back those losses. Their operating income went up a lot from 800 million to 1.4 billion. REITs tend to take on a lot of debt because in order to grow and buy more properties, they need to either take on equity or debt. Because 90% of their profits are paid back to investors in the form of a dividend. So they paid almost 400 million of interest on their debt in 2021, which was higher than prior years. Other income and expenses are all the gains or losses not part of the company's core operations. This gain was on a lease modification. I'll show you that on the company's income statement in a little bit. Then you have your pre-tax income, and REITs don't pay much in taxes. That's the main benefit of being a REIT. You pay less taxes than a traditional corporation. Their net income was over 1 billion in 2021, nearly double 2018. This is their income statement from their annual report. 1.2 billion of their revenue is from the lease payments on our properties, and 31 million of golf revenues. If you played golf at one of the properties this REIT owns, then the green fee you paid is part of this REIT. They spent 33 million in general and administrative expenses, 3 million in depreciation, 28 million of other, 21 million to maintain their golf courses. They had a gain of 20 million credit losses. Last year they posted 245 million of credit losses. That's why their operating expenses were so high. Their earnings per share in 2021 is $1.80. It's up 4 cents from 2020, which is up a lot from 2019 of 125. They increased their shares outstanding each year from 435 million to 506 million to 564 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Their cash flow goes up each year. It's almost 900 million in 2021. They haven't been spending much in CapEx, only 23 million in 2021. Operating cash flow minus CapEx gives you your free cash flow. and most of their free cash flow goes towards their dividend payment. In 2021, it looks like $2.1 billion of debt was due, so they added $2.4 billion of equity. Every year they add capital stock. Last year it was $1.5 billion. Before that it was $1.2 billion and $2 billion. Every time a company adds common stock, it increases the shares outstanding and makes your shares less valuable. They did add a lot of debt in 2019 and 2020. They were probably concerned about lower revenue during COVID, so they added debt and equity that year. But things seem to be going well, so they didn't add any debt in 2021. This is their operating cash flow section from their 10K. And the way you calculate operating cash flow, you start with your net income of $1 billion. Then we have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. So even though they reported a $1 billion profit, they actually generated $900 million of cash flow. In 2020, we add back that $245 million credit loss because that's a non-cash item. It's similar to just posting the money as collateral. And in 2020, they passed through a big gain of $333 million in a lease modification. Since that's a non-cash item, we minus that out here. This blue line is their revenue and it's been going up a ton. And the orange line is their operating cash flow, which is also going up a lot. So far, the company seems to be doing a really good job. And the forecast is for their revenue to continue growing through 2024. Same thing with their operating cash flow. This is their investing and financing sections from the statement of cash flows. When they lease out their properties, that goes into investing cash flows. $1.8 billion in 2019, $1.4 billion in 2020. They have $2.7 billion in financing receivables, over $500 million of loans. If the hotel needs money, maybe to add a restaurant or to fix up some rooms, this company may give them a loan. In their investing section, they had a cash inflow of $41 million in 2021. Last year was a cash outflow of $4.5 billion. So they did a lot of growth in 2020. In their financing section, they added $2.4 billion of debt. They paid down $2.1 billion on a term loan. They paid out $758 million of dividends. So they had a cash outflow of $500 million. Last year was a cash inflow of $2.9 billion. When you look at a REIT, you want to look at funds from operations. And that's gone up from $1.76 per share in 2020 to $1.80. This tends to be a better indicator of how the company's doing than net income. And you want to compare this number to prior years for a company and also compare it to similar companies in their industry. This is the equity section on their 12/31 balance sheet. They have $12.1 billion of equity. They raised $11.8 billion from selling their business, and they profited $346 million from running their business. Let's look at the capital structure. $12 billion of equity, $5 billion of debt. They're 71% equity, 29% debt. This blue line is their equity balance, and you can see that increases every year, and that's what you want to see. The red line is their debt balance. It did go up, but it came back down in 2021. And their cash balance is the green line, which is pretty low each year. All in all, it looks like a pretty good capital structure. I gave them the highest whack on Finbox of 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $32 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $29 billion. We divide that by 748 million shares. And we get a calculated stock price of $39. They're trading at $29, so they're trading at a 25% discount. It's a buy according to the model. Their revenue is projected to grow 19%. I cut that in half to 10%, and I grew their revenue 10% for the next 4 years. That's how I got their future revenue estimates. They convert 65% of their revenue into free cash flow, so I multiplied their future revenue estimates by 65%. That's how I got their future free cash flows. Even with a conservative revenue number and a high whack, the stock still seems undervalued. The website Simply Wall Street is a lot higher than me. They're at 107 a share. They're saying it's 73% undervalued. 10 analysts priced this stock and the average is $35. The low is $31, the high is $46. This is where the stock has been trading historically. The stock price was doing well up until COVID hit. Most stocks, especially REITs, crashed. And that was its low point, but it's come up a lot since then. It has been regressing the past few months. It's up about 10% in the past 2-3 weeks. These stock price movements are pretty similar with lots of other companies. If you invested in the S&P 500 when VICI started trading, you'd be up 67%. With VICI, you'll be up 44%. But VICI pays a nice dividend, so if you included the dividend, they would be a little closer. But I've never seen a stock track the S&P 500 so closely. It was almost identical until July 2021. In August of last year, VICI announced the acquisition of MGP. That's a ticker for MGM Resorts. And that includes some really nice properties. Mandalay Bay, the Mirage, MGM Grand. These are other properties this REIT owns. Borgata, Gold Strike, and lots of MGM properties. When they started in 2017, their top tenant was 100% of their portfolio. Now their top tenant is 42%, Caesars. They started with a 26-cent quarterly dividend and they raise it every year. They're up to 36 cents, which is a 5% dividend yield. That's 123% of their free cash flow. But over time, it should equal about 90% of their free cash flow. Their dividend yield has been fairly steady over the years. It's expected to hit 5.6% by the end of 2024. But most of the dividends you receive from a REIT are taxed at the higher tax rate. When you invest in a regular company like Microsoft, you're taxed at the lower tax rate, the qualified dividend rate. When you own this company's stock, you're taxed at the ordinary dividend tax rate, which is the high tax rate. They have a beta of 1.14, so the stock pretty much moves with the market. It's pretty much flat in the past 52 weeks, while the S&P is up 14%. The 52-week low is 26, the high is 33. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. Over 10 million shares are traded each day. Of the 748 million shares outstanding, 746 million are on float. Most of the shares are held by institutions, and a short percentage is 4.25%. REITs usually don't have many employees. They currently have 129. If you invested $10,000 into this company when they started trading, you'd have $18,000 today. That's a 15% annual return. In the past 12 months, there's been only insider buying, no selling. That's what you want to see. Pretty much all the shares are held by institutions, only 0.2% by individual insiders, and 3 basis points in state or government. Let's look at their financial ratios. They have a PE of 21, that's stock price over earnings per share. They have a high price of sales of 14. They have a good price to book of 1.8 since they have so much real estate on their balance sheet. Their price to free cash flow seems a bit high at 25. In a little bit, we're going to compare all their ratios to companies in their industry. Let's look at their assets. The present value of the future lease payments on all their sales type leases is $13 billion. The present value of the future lease payments for their financing leases is $2.6 billion. The capital expenditure loans they provided to the lessees is $500 million. They own $154 million of land. They have $740 million of cash and $425 million of other. Let's look at their liabilities. They have $4.7 billion of debt, $113 million of accrued expenses. They have $226 million of dividends payable. They're not past due on their dividend payment. They declared the dividend, but the date hasn't come up yet. On the actual dividend date, then they'll remove this amount from their balance sheet and pay it to the common or preferred shareholders. And they have $376 million of other. They generated $870 million of free cash flow in 2021. They have $3.5 billion of working capital, and they paid out over $1 billion of dividend payments. So they have $3.4 billion of funding. So the company does seem to be well capitalized. The best way to look at ratios is to compare them to companies in the same industry. There are 31 companies in the same industry as VICI, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. Pretty much all REITs pay a dividend. It looks like only one does not. Their dividend is higher than average. The average is 4.3%. They're the largest company on this list. Their price to book and price to earnings are better than average, but their price to free cash flow and price to sales are worse than average. They have a really good 3-year annual growth rate of 19%, average is 7%, and their ROA and ROE are better than average. So to summarize, I have them trading at a 25% discount. I think demand for casinos is always going to be high, except maybe during a pandemic when people are locked in their homes. But outside of that, I think casinos will have plenty of demand. The main risk is the prices of real estate. If the prices of real estate come down a lot, then this company may start to take losses. I don't see that happening, but that is something to consider. But it seems like a pretty safe stock and a safe dividend. So I think it's a great long-term hold. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.